that don't want what we know out there.
How a person can go from really almost nothing to becoming a millionaire by owning rental properties.
He would always buy these flip houses, and I just remember thinking, this guy is crazy. Why would he buy that house?
In the past decade, there's been a huge surge in the peer-to-peer short-term rental market.
Become an insider. So you have to know the rules before you get the game.
Every second counts. So make every second count.
Welcome to the Real Estate Jam. Whether you're just beginning or the best of the best, we're glad you're here. We will share successes, failures, and strategies for the action-taking real estate investor. And now to your hosts, JD and Melissa.
Hi guys, welcome to the Real Estate Jam podcast. I'm JD, and unfortunately, my lovely co-host Melissa is not going to be able to make it today. She's not feeling good, so she's taking a rest, and hopefully she'll be back at it for the next week. But the show must go on, as they say, and I am super excited to introduce you guys to a broker and investor with over 40 years experience in the real estate industry. He's the founder of Spark Investment Group, 1,100 plus units, portfolio worth $138 million. Arn Cenedella, thanks for coming on the show today.
Yeah. Hey, JD. Great to meet you. Thanks for inviting me on your podcast. And hopefully we can provide your listeners some value, help them, further their investing efforts and build their portfolio.
Yeah, absolutely. Well, Arn, starting out, can you kind of give me a little bit of a rundown? Now, obviously, 40 years is a lot to sum up in a couple of sentences, but tell us, where you came from, how you got into it, and where you're at now, and we'll just kind of take the conversation from there.
Yeah, sure. So I was kind of a typical middle class American kid, went to college, went to grad school, got a degree in chemistry, decided I was done with academics. So I called my dad. I grew up in the San Francisco Bay Area, Menlo Park, Palo Alto, watched it become Silicon Valley. And my dad had a residential brokerage business. And he said, come on out, get your license, and I'll put you to work. So that was March of 1978. Built a successful single-family residential brokerage business, started buying single-family rentals, worked in the Bay Area for about 35 years, and about 10 years ago, moved to Greenville, South Carolina, clear across the country. And about the time COVID broke out, I kind of transitioned my business and my own investment portfolio into multifamily and founded Spark Investment Group.
Sure. I think that, I left the military in 2020 and decided to start we had started investing down here before, but what contributed you to make the decision to pack up from where you had been working for 35 years, building a business, building connections, relationships in the area, and move all the way across the country to essentially start over or start over in a new location?
Yeah. Well, theoretically, we were going to retire, but of course, the definition of retirement has changed. We're living longer. People are healthier, more productive. We know Social Security isn't going to pay the bills, so we got to, find ways to create income outside our W-2, outside our career. We love the Bay Area. Both my wife and I spent most of our life in the San Francisco Bay Area, but we were just kind of ready for a change, a little bit slower pace of life, a little more relaxed lifestyle, certainly more affordable, and we made the move to Greenville. Ecstatic. It's worked out great for us, so we're very happy here, and it just happens to be a fabulous real estate market halfway between Charlotte and Atlanta. And most of your investors understand those are two powerhouse metros in the U.S. economy and the market. And we're 90 miles from one, 120 from another, right on I-85. We understand how important logistics and transportation is. So happen to be a real strong real estate market. And of course, coming from the Bay Area, everything seemed inexpensive. So, yeah, so that's an understatement. And then right when COVID broke out, I had a conversation with a young investor friend of mine here from Greenville who had started to move into multifamily, started to do a few syndications. And at the end of the conversation, he said, "Hey, let me send you a podcast." And it was from a guy named Neil Bawa, who many of us in the multifamily space know, another ex-Bay Area. Well, he still lives in the Bay Area, ex-tech guy. And I kind of got hooked on multifamily, and we can get into why I kind of made that transition, but that was the start.
Okay. Yeah, I mean that makes sense. I am curious, what does your team look like today? Your investment team, you guys over there at Spark Investments, do you have a list of employees? Are you running it solo? Do you have virtual assistants? So how are you making the business happen?
Yeah, great question. So basically, Spark is a one-man band. I have a virtual assistant in the Philippines, and then I have two primary partners. Brian Walsh, who lives here in Greenville with me, and he handles kind of the day-to-day operation. And then a friend up in the Raleigh-Durham area of North Carolina who kind of acts as our CFO. So Dan's the CFO. He does the underwriting, keeps track of the money, does the finance and accounting. Brian, trained as a master plumber, has a property management business. He handles the day-to-day rental operation. And I'm kind of the deal finder and the capital raiser. So it's a three-man team. We're equal partners. There's no formal business agreement, but basically we think about investing in a similar way. We like each other, and we each have a lot of investing experience ourselves. But that being said, we each bring a certain skill set to the team, and kind of the combination of the three of us has got all the bases covered.
Okay. Yeah, great. Well, I think, for our listeners, when most of our listeners are either small multifamily, so you're thinking duplex, triplex, fourplex, or single family homes. Now, some of our investors may be in trailer parks and some of the a little bit larger, but I think the transition when you're fix and flipping yourself, buying or doing 1 to 2 houses a year, making the transition from, picking up 1 or 2 rentals a year to picking up a 100-unit portfolio, 200-unit portfolio, apartment complex, trailer park, storage units, that kind of stuff. I think that seems so far down the road, so it almost unattainable when you're looking at buying $100,000 house versus $50 million property or $20 million property. Can you talk about, one, the mindset shift that you have to make going from a single unit to multi-unit, and then the skill set that you need to work on to be able to transition those skills from single family to multifamily?
Yes. And I was a single family investor for 35 years. So shout out to that. It's a tried and true way to accumulate wealth and income. So doing it the single family route, perfectly A-okay. It's proven. I think the shift to multifamily, often when people own single family or 2 to 4 unit deals, it's often a solitary endeavor. There's a man and woman or a single who owns these properties and kind of does everything. Where with the multifamily, it typically tends to be a little bit more of a team sport where 3 or 4 partners get together. And what that allows is each person to focus on what they really like and what they're talented at. And then from there, in terms of scaling up to the amount, the largest deal I ever did was $35.5 million, but most of my deals are $3, $4, $5 million. we raise $1.5 million, $2 million. And so I think to partially make the transaction, certainly if you have a portfolio of single family rentals, you could 1031 them into a larger apartment building. I mean, if you have 10 single family homes with 100,000 equity, which is certainly not a ridiculous amount, that's $1 million equity, which means you could buy a $3 or $4 million multifamily, or you partner with others, kind of pool resources to buy a bigger asset. I think a lot of it depends on how actively involved do people want to be in the day-to-day operation. So to the degree you enjoy the day-to-day interaction with the tenants and dealing with the repairs and this and that, I think then that kind of tips the scale towards single family. To the degree you don't want to be involved so much in the day-to-day, then scaling kind of reduces that. You can get on-site property management. The property management tends to be more professional, and you have teammates to handle. So I think to a large degree, it's a decision on where you want to spend time. And some people, when they get to a certain point, they don't want to have to deal with the day-to-day of owning real estate, which, as we all know, can be problematic from time to time.
Sure, absolutely. But once you're up to 1,100 units, I imagine that you're still having to manage the managers and manage the projects and manage everything else. Maybe not on a day-to-day basis, but you're looking in on a $138 million portfolio on a regular basis, huh?
Yes, and it is a full-time job, but the part of it that I take care of for my team, it's something I really enjoy. And when you enjoy something, it doesn't seem so much like work. I don't want to deal with getting the toilet fixed. My partner, Brian, loves doing that. So you can kind of spread the work. But yes, running a large portfolio is nothing to take lightly. I've been in the real estate industry over 45 years. And we work with other investors. And of course, we have a responsibility to our investors, most of whom will probably invest $50,000 each a deal. So we're not dealing with people who bring in $1 million. We're dealing with average people who are just, trying to make do, try to prepare for the future. So, we have a duty and a responsibility to take care of their capital and run the property in a professional manner. So there is responsibility, there is work, but you can kind of divide it up and specialize in what you do best.
Sure, absolutely. Now, going back to how you made the transition, did you go straight from owning these single family homes to starting your own syndication? Did you come on as a limited partner first and then transition over to running your own deals? What did that look like for you?
Yeah, that's a really good question. So, as I decided to move to multifamily, I started as a limited partner and invested 50,000 here, 50 here, 25 here, and 5 or 6 deals with various operators across the country. And then as I got to know these operators, I would let them know, hey, I've been in real estate. I have the ability to raise capital. And so if you ever need some help on raising capital, please let me know.
Everybody always needs money.
Yes. And so maybe about 6 months after I had made an initial investment with this one operator, he called me. He goes, Arn, hey, we got a deal down in Augusta, Georgia that we need some help on. And that was my first step into the active side, to the GP side of multifamily. And I was what was called a co-GP. I wasn't the lead operator. I wasn't the decision maker. I was simply there to support. I helped raise capital. I put in earnest money deposit. I was on site when we did the inspections. And I did that 2 or 3 times. And then I knew I wasn't a great operator per se. And so I had a local property manager here, Brian, and over the years, I turned over my rentals to him. We developed a relationship, and I came to really trust his ability to properly take care of these properties. And it took me about 18 months to convince him to come to multifamily. I go, Brian, let's take a look. And Brian would go, hey, look, I do single family. I'm happy with it. I'm doing good. But finally, we found a property. And this is probably about the fourth one we looked at. And he liked it, I liked it, we bought it, and that was our first one, May of 2021. And one of the nice things about apartments, this was just a little 43 unit deal, it was about 3 million. And what's nice is you got 43 income producing units right in one location, as opposed to having 20 or 30 houses spread out. So he really liked kind of the economies of scale. The other thing for your fix and flippers, when you do a house, every house is pretty much unique. So every time you go in, you kind of got to reinvent the wheel and figure out where the cabinets go, how much counter space. With multifamily, generally the units are of 1 or 2 floor plans. So as soon as you renovate one, you know exactly how much countertop you need, what sink to buy, what toilet, how much LVP. Yes, copy and paste. Exactly right. You put the order in with Home Depot. You go, I need 2 packages for the cottages. The next day they're on the dock at 7 o'clock. And running crews. If your guys are going back and forth, it's costing time and money. So to the degree you could get everything right there and they can just go to town, it saves money, reduces vacancy. So it's a great thing.
Yeah, absolutely. So now you tell me what a typical deal from start to finish looks like. Are you working with brokers? Are you contacting owners direct to seller? Are you finding stuff off of the commercial MLS? What are you doing to find these deals? And then kind of what's your criteria look like? And then how are you getting it to the finish line?
So in terms of how I find deals, I would say it's all of the above. If when you're hunting deals, you have to be kind of firing on 2 or 3 different cylinders. So certainly work with the local brokerage community. And to the degree you show you can perform, that's going to help bring you other deals. I mean, I was a broker for a long time. I still am a broker. And, brokers like to get paid, and they only get paid when sales close. So when you close the sale, now you're their friend, they'll bring you the next deal. We do a direct to seller campaign. I have a young guy who's kind of an intern wanting to learn the multifamily business. He cold calls into owners and he's doing a great job. Not easy cold calling. You got to have the right kind of personality. You got to let people hang up on you and just start dialing the next number. I'm also very active on social media within the local brokerage community. And we actually just closed $4.6 million deal, 13 new duplexes, basically on a connection I made with the contractor on social media. So that's how we find them. And then basically we'll get them under contract, start our due diligence. And on these multifamily deals, usually you get about 30-day due diligence. Mm-hmm. Residential, maybe you get 15, but multi, you usually get 30. And then they're usually structured close 30 days later, perhaps with another 30-day extension. And so as you start going through your due diligence, you're fine-tuning your underwriting. You do an initial underwriting when you make the offer. Then as you do your due diligence, fine-tune your CapEx budget for a value-add project. You start fine-tuning your underwriting. And then ultimately you put together an offering package that you then send to your investors. We follow it up with a webinar. And so we're simultaneously trying to raise capital to close the deal while we've applied to a bank or credit union to get a loan. And so there's a lot of balls in the air. And oftentimes you have earnest money up and it's hard. And if you can't close the deal, you can lose it. So it's not, you have to know what you're doing. It's not for the faint of heart. On our first deal, we had to raise $1.5 million. We weren't sure we could do it, but we jumped in with both feet and got it done. And now we've kind of developed a track record, so it's a little bit easier. And then 60, 90 days, you collect the investor's fund, you get the lender ready to fund, you close the deal, typically LLCs, and we pay quarterly distributions. We have an investor portal, so a lot of it is automated with the signing of all the docs and things like that that the investors need to do.
Okay, and how are you evaluating these deals to either be able to come up with your offer or know that it's a good deal? Are you making decisions based off a cap rate? Are you purchasing based off of pro forma, where you can get it? What does it look like when you're actually making those decisions?
Yeah, so I may be a little bit different than many investors. I think investing is both a quantitative exercise, running the numbers, doing the spreadsheet, doing the math, calculating the return metrics. But I think with investing, there's also a qualitative aspect where when you know your market, you have a competitive advantage. You know where the good pockets are, you know where maybe the less good pockets are. So for me, it's kind of a combination of both the numerical returns, but also I kind of look at the quality of the property, quality of the location. The other thing I would say is I'm more of a long-term investor. So I kind of think about 5, 7, 10 years from now. So maybe the immediate numbers aren't quite as critical. It's more, where do I think that property will be? Where do I think that location will be 7 to 10 years from now? So certainly we don't buy negative cash flow. Certainly we want the property to cash flow. But the way I kind of look at the cash flow, it's not so much to put money in your pocket to spend today. It's more to make sure the property's self-supporting. So you buy an asset, you invest X number of dollars of capital, and you don't have to put any more money in the property. The property pays for itself. And then if you buy in a growth market like Florida, like the Carolinas, you have a pretty good idea over time rents and values will increase. Mm-hmm. So that's kind of, I do it. I don't have a particular numerical metric. I would say my approach is more about line drive base hits and ground rule doubles. I'm not swinging for the fences. I'm not swinging for the once in a lifetime deal. I just want to get steady wins. You just keep eating line drive base hits, you're going to win the game. And if you take a 10, 15 year period and you just start building your portfolio, 10 to 15 years later, you're going to be financially free. And the real trick is, don't take a mortal loss. Don't make a big mistake that kind of wipes you out, because one, you may not recover emotionally from it, but you may not recover financially for it. So what does Warren Buffett say? Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And so I think as investors, if you're presented a deal that just sounds too good to be true, it probably is. So know your market, know what reasonable returns are. For us, most of our deals, we're probably going to average 5 to 6% cash on cash, maybe investor IRRs 14, 15 over a 5-year period. And that's perfectly fine with me. That's doubling your money every 5 years. And to me, that's a win, especially if you can do it safely without any losses along the way. You're just going to steadily accumulate net worth and income.
Sure. And bad or how much is the current interest rates affecting what you're able to do, how you're able to buy? I mean, I assume that you're still working on like adjustable rate mortgages with balloon payoffs and stuff. Are you afraid of that?
Yes, I'm old. I'm 69 years old. My dad, who was born 1921, taught me the real estate business. So we only get fixed rate debt. We don't do any adjustable rate debt. And as you know, for multifamily, most of the loans are about 5 years. So you can't get a 30-year loan on an apartment building. So we do fixed rate debt. The last couple deals we've closed, we've paid 7% from a local credit union. Get maybe 1 year interest only. Then it goes to 30-year AM, which is unusual. Most local banks go 25-year AM. No prepay. So if and when rates drop, and you can refi without much cost. So basically what it takes now is you just have to put more cash down. So the last couple deals we've done, new construction, built to rent product, duplexes, we're putting about 40 to 45% down to acquire them and then produce enough cash flow that the property's self-supporting. And of course, if rates drop to about 5, which I think is a reasonable expectation, I don't think we're seeing 3 again. We maybe see 4, but I don't think we're seeing 3.
Right.
If rates drop to 5, we could refi and all of a sudden the cash flow jumps up a little bit. No guarantee. If they don't drop, we're still good because we got fixed rate debt for 5 years. So hopefully within the 5-year period, there'll be a window to refinance into some longer term debt at a little bit lower rate.
Sure, absolutely. Well, I think we've discussed a whole range of stuff with the multifamily and touched a little bit on the syndication portion of it. But if our listeners wanted to find out more about what you guys are doing at Spark Investments and about multifamily investing, or maybe some of them are, I guess I should ask before I go into that. I assume you're looking for accredited investors, or are you guys able to work with non-accredited investors?
Yeah, we're actually able to work with non-accredited investors. We do the 506B as in boy, not the 506C as in Charlie. And basically, with the 506B, they have to be sophisticated investors, and there's no two-line definition of them. You're exactly right, JD. But more, we have a conversation with the potential investor to try to understand their financial situation. What's their job like? What's their credit like? Do they have savings? And do they just basically have enough financial knowledge to adequately assess the risk and the rewards of a potential investment? So people may have stock. The other thing, of course, is we never want anybody to invest their last penny with us. People need a rainy day fund. Once your rainy day fund is set, then whatever cash is left over, you can invest. So we do the 506B, usually $25,000 minimums. And to us, it's like younger people working hard, trying to do the right thing, trying to get ahead. Why should the benefits of buying multifamily only be available to a certain income level or net worth level? Because really, what we try to do is take those non-accredited investors and make them accredited in a couple of years, right? By real estate investing, their net worth goes up, their income goes up. So that's really the plan. Take these people who are working hard, they're smart about their money, they're investing for the future, give them a chance to actually grow their net worth and provide for their family. And so we love that. There's kind of a personal relationship there that has to be developed. And that being said, accredited investors can join too. So it's not one or the other, it's both and. Yeah. Yeah.
Awesome. And so if people wanted to find out more about what you're doing, where can we send them? Where can they find out more about your company and what you guys are doing?
Yeah, thanks, JD. So the name of the company is Spark Investment Group. I'm very active on social media, either Facebook or LinkedIn, either under my individual name, Arn Cenedella, or Spark Investment Group. Website is pretty simple, investwithspark.com. No dots, no dashes, investwithspark.com, and reach out. Happy to talk and help people become better investors.
Awesome. Well, Arn, hey, I really appreciate your time today. Thank you for coming in and sharing with our community. And we'll see you next time.
Yes, and hope. Wait, Melissa?
Yep.
Hope she's feeling better. Sorry I missed her, but hopefully we'll bump into each other again.
Awesome. Thanks, Arn.
Okay, thanks, JD. Yeah, thanks.
Thank you for listening to the Real Estate Jam. We hope you enjoyed today's episode. For more information, check out our website, therealestatejam.com, or find us on Instagram, Facebook, and Twitter at The Real Estate Jam. If you have any questions, feel free to drop us an email at therealestatejam@gmail.com. See you next episode.